Hello, my name is Brent Sondrum from the Department of Agricultural, Environmental, and Development Economics at Ohio State University. I'm here today with my colleague, Professor Ian Sheldon, Anderson's Chair in Agricultural Marketing, Trade, and Policy. Dr. Sheldon has written extensively on international trade policy, especially in the context of agriculture, and teaches courses on trade and agricultural policy. The topic of today's conversation is international trade in the era of COVID-19. Dr. Sheldon, welcome. First question we'd like to ask you is, how has trade in general been affected by the pandemic? We've all heard stories, seen things on the internet or seen things on the news about trade, but it's still a mystery to most of us because we don't see our stuff traded. Can you tell us a little more about that?
Yeah, actually, the pandemic's had a pretty drastic effect on international trade. In fact, the impact has been even greater than it was during the financial crisis back in 2008, 2009. I'm just going to bring up a slide here. Hope everybody can see that okay. If we just track back up here, you can see that this is international trade going way back to 2006. This was the financial crisis, and this is the pandemic. And you can see that overall we've seen a 27% reduction in global trade, which is pretty significant. And this graphic here gives you a little bit more detail over the last 3 years, and you can see if we look at the brown line, this is annual growth in trade. You can see trade was sort of trucking along at about 3% growth per annum, and then the slowdown in the world economy we're starting to see a slowdown in international trade. Even during 2019, this is partly driven by the trade war that the US has been having with China. But then you can see you get this significant slowdown in international trade as the pandemic hits. So we're talking about the annual rate of growth of trade is now about -5%. That's kind of what the WTO was forecasting back in April. And then if you look at the blue line, this is an even more drastic way of seeing it. You can see that through quarter 1, quarter 2, international trade has literally fallen off a cliff. So we're talking about 27% reduction in international trade, and a pretty significant decline in the value of international trade. And really, we're not seeing any bounce back yet because the global economy is still on the downside, I think, in terms of economic growth.
So, one of the things that's sort of always struck me about this question of trade is I've heard that agriculture is a huge part of American trade, at least. So I'm kind of curious, this must have affected agriculture as well. I mean, what I can't tell from these figures is whether this is goods coming into the U.S. or goods going out of the U.S. I understand.
No, this is not U.S. trade. This is global trade. So whichever way you measure it, you can either measure it through imports globally or exports. Typically, it's done through import data because we tend to do a better job recording import data because we're going to charge tariffs or taxes at the border. So in terms of agricultural trade, globally, the slowdown in agricultural trade is forecast to be a little less than you would see, say, in international air transport or international retail. But for the US, I mean, agricultural trade is one of the bright spots for US trade, in the sense that I don't mean just because of the pandemic, but remember the US runs and has run for nearly 3 decades a very large trade deficit in aggregate, about $800 billion a year at the last measurement. But one of the few sectors where we do actually show an export surplus is agriculture. So we're pretty good at exporting agricultural commodities. In other words, we have a very strong competitive advantage in agriculture. And it's interesting if you look at the trade data in the first 5 months of this year. Now, let me just bring my numbers up here. It looks like if we just look at agricultural trade with China's, at least historically over the last decade, has been our #1 export market. In 2019, China's agricultural imports from us were around $4.5 billion. And right now, that's 5 months into 2020, compared to last year, China's agricultural imports from the US are running at 7.2 billion. So their imports from us have actually doubled in the first 5 months of the year. And to give you an example that may be of more interest to farmers here in Ohio, for soybeans, last year up to the end of May, China had imported $2.1 billion worth of soybeans. And right now they're running at about $3.6 billion worth of imports of soybeans from the US. So there's a little bit of positive there relative to the global trade situation. And what I think is probably the case with global agricultural trade is that our exports to China in particular have held up pretty well. And in fact, if you look at the US's overall trade in agriculture, by the end of April, we were about a modest couple of percentage points above where we were a year ago. And I think that's mostly being driven by the fact that China started to come out of their lockdown earlier than the rest of the world and started to import more commodities. And secondly, of course, we've signed this phase one trade agreement with China, where China's made these commitments to import more from the US, both generally and with respect to agriculture.
You know, I wanted to follow up on two things that you mentioned. One, early on in that discussion, you talked about the trade deficit and how big it is. I was wondering if you could just explain the trade deficit briefly to people and just sort of let us know, why is that important to worry about something like a trade deficit?
Well, the trade deficit, you have this thing called the balance of payments, which is made up of two pieces of accounting. One is called the capital account, and that would just measure the financial flows in and out of the US. And then you have the current account balance, which is our trade in goods and services. And if you just look at goods trade, we import more than we export. So we're running right now about an $800 billion current account deficit if you just look at goods. But on the other side of the ledger, foreigners are happy to invest in the US, and so the balance of payments balances. Remember that American treasuries are considered to be the safest asset on the planet, so a lot of foreigners like to buy up US treasuries as a relatively low risk form of investment for their sovereign investment funds. So the balance of payments always has to balance. If it doesn't balance, you typically get a depreciation in your currency, or you have to start using your foreign exchange reserves to balance your balance of payments. But remember, the dollar is the world's global currency. So even though we run this very large trade deficit, at least historically, we've never had a balance of payments crisis, say like a country like Argentina has had recently. In other words, our economic fundamentals prior to the pandemic weren't too bad. We had brought down our debt to GDP ratios after the financial crisis. We have low inflation. We had high rates of economic growth. The pandemic has obviously thrown a huge amount of uncertainty into that. But the point about the trade deficit is that starting a trade war with China isn't going to solve that problem. The reason we run a large trade deficit is that Americans have a very high proportion of our GDP goes into consumption, and we have very low savings rates. And if you have low savings rates, that tends to feed into, we import more than we export. And we have a little bit of a problem with what we call the Twin Peaks problem. We're running even before the pandemic, we were running a very large fiscal deficit. We spend more as a government than we bring in tax revenues. And the combination of running a budget deficit and low savings means that feeds into a high trade deficit. And in fact, our trade deficit hasn't moderated that much since the trade war began. It's moderated a little bit with China, but you stop importing more from China, you just substitute imports from elsewhere. It's a structural macroeconomic problem, basically.
It's super interesting. So we're basically running a trade deficit in general, but with agricultural commodities, they're a bright spot in that. I think you said that. We export more of those than we import.
Yeah, because the U.S. has a very strong comparative advantage in producing commodities like soybeans, corn, processed pork, processed poultry, wheat, you name it. We're pretty good at it. And, if you don't mind, I can show you I'm just going to stop showing this graph. I'm going to show you another one that also highlights this, this graphic here. This shows you the importance of China, or historically the importance of China for our agricultural exports. So China joined the WTO back here in 2001, and you can see we were exporting only about what, $3.5 billion worth of exports to China. But you can see that as China opened up its economy, and in particular, China's had this massive increase in demand for animal protein. They want to consume a lot of pork, a lot of poultry, and they've built up a huge productive capacity for those products in China. But they need to feed those animals, so they need to feed them particularly with soya protein. And you can see up to about, around this period here, we hit this massive, we went from $3.5 billion to $25 billion worth of exports to China. And most of that was in soybeans, actually. So China has been an incredibly important market for our soybeans. And outside of China, our other major export markets would be countries like the European Union. Obviously, most of our trade actually in agriculture is with Canada and Mexico, because we're in the North American Free Trade Agreement, or the USMCA as it's now called. So the combination of NAFTA, China joining the WTO, and some other countries in Southeast Asia who are big importers, this has been a bright spot for international trade. But I would point out that after this peak, you've seen this, this downward trend. So this is 2018. This is the beginning of the trade war with China. At the end of 2017, we were exporting about $24 billion worth of product to China. So it had hit a peak up here. It was declining here. But then the trade war comes in at the end of 2018. We're still exporting a lot to China, but it had fallen to 16 billion. And I think it's fallen to about 9 billion in the last year, in 2019. So yeah, agricultural exports are very important to the US. Remember though that one of the reasons for this decline is falling prices. Brazil is really competing very heavily with us in the soybean market. They have high productivity, low prices. The real is a very badly performing currency, so their soybeans are very cheap and are still sort of reaching the quality level of those in the US. But remember, we export a lot of tons of soybeans, but it's a relatively low value product. So yeah, we run a trade surplus in agriculture, but it's not enough. I mean, just look at these numbers. They're nowhere near enough to match that trade deficit that we're running of $800 billion. So, agriculture is very important it's important to agriculture. It's very important to farming here in the state. Our number one export is soybeans. Before the trade war, about 1 in 3 rows of soybeans were going into China. It's about 1 in 10 now since the trade war started.
Interesting. I mean, do you expect that, if you were to project next year, the year after, do you expect that we'll actually make it to this phase 1 deal that you have written on here, 43.5 billion? Do you think that's going to happen, or will the pandemic do something to alter the trajectory here again?
No, I don't think we will. I'm very skeptical, and I've said this publicly back when the deal was signed. So you just think about the economic reality. That's why this slide says the current reality. And if you look at this number up here, through May 2020, China had imported $7.2 billion of agricultural commodities already this year. But that's 53% below the target you need to reach at this point in time in order to hit the end of the 2020 target, which is they're supposed to import $36.6 billion worth of agricultural imports by the end of this year. So we're talking about, we're up to what? We're about here right now, right?
Yeah.
7 billion. And we're talking of getting up to what? 36 billion by the end of this year. This is where we were going on trend, right? This is where this is the sort of most optimistic Chinese growth forecast. This just doesn't seem realistic to me. In other words, China was agreeing to massively increase their imports, which this is a form of managed trade, right? This sounds like what we were doing with Japan in the 1980s, where China is ordering its state-owned enterprises to import more agricultural commodities from the US. And I think what the pandemic has done is just slow this down even more than that we would otherwise have expected.
It's fascinating to think that we make these trade deals and do all this work, I guess, for them, and then, you know, pandemic can potentially affect them. Maybe there's other factors that play into it. Would other factors play into it besides the pandemic?
No, I just think, well, I think that to me, this is a very simple economic logic. Unless the Chinese government formally subsidized these imports, and I've seen estimates that so the import subsidy would be the gap between the price the Chinese would have to pay American farmers to export to China and the price inside of China. And that subsidy could range anywhere from 12 to nearly 45%. So that's very trade distorting, right? Just look at the numbers here on my screen. The economic reality was, even without the trade war, right, their imports would have been anywhere from, you know, 10 to $20 billion lower than what we're trying to get them to import. And remember, at the same time that they've made these commitments, they haven't got rid of the import tariffs on soybeans and other commodities coming in from the US, but they don't have those tariffs on imports from Brazil and Argentina and Australia and New Zealand. So if you're a private trader inside of China, not a state-owned enterprise, supposing you're Cargill China, right? What are you going to do? Are you going to import from the US and either have to get an import license from the Chinese government and get the tariff reduced, or you're going to import from Brazil at effectively the world price? And I don't have a graph here to show you, but exports by Brazil to China in the first 4 months of the year have been going gangbusters, because Brazil had a very good crop, very low prices, relatively high quality soybeans. And essentially the US was already losing market share to Brazil, and the trade war has sort of exacerbated that loss of market share to Brazil. And it's going to be very hard, I think, to get back a lot of that market share, or at least a significant portion of it. So I'm rather pessimistic about China actually meeting those commitments. And I think the pandemic's sort of thrown a political wrench into the works as well, and the whole business with Hong Kong as well.
A fundamental or interesting thing here is that, you know, if you leave it to markets, you may have a better solution than if you move away from markets and move away from free trade. I mean, we may be worse off because we don't have free trade now, right? And that's essentially what you're saying.
Well, I mean, what the trade war did was destroyed export markets for the US, a major export market for the US, and we never made up the difference by exporting elsewhere, right? So the net destruction of US trade has been about $14 billion worth of trade to China. But a lot of trade that was coming in from the US into China got diverted to countries like Brazil, the EU, Argentina, Australia, and New Zealand. And that's just inefficient, right? Trade diversion is taking trade away from the most efficient supplier, which was probably the US, and diverting it to other suppliers like Brazil, which is an efficient supplier, but more than they otherwise would have got, you know, if we traded at world prices. But this, if you were to hit, you know, if you were to actually hit this target, you would reverse that trade diversion, right? But think about where the US was before the start of the trade war, right? We were losing market share. If we were to go all the way up to here, we're talking about what? Nearly doubling international trade over a 3-year period. That would have led to massive trade diversion in reverse, where exports by Brazil and Argentina would now be diverted to the US. Does that make sense?
Yeah.
So all we're doing is the trade war distorted the international market, and this commitment to manage trade by China through state-owned enterprises and potentially, distorting trade that way just doesn't make any sense to me as a trade economist. I mean, politically.
But if I was to boil this down, it seems like, we went away from sort of quote unquote a free trade system to a system where now we're in order to achieve what we want, which is more exports, we have to rely on someone else to provide a subsidy or a tax in their own country. And that's, to me, that's just relying on something that's unpredictable.
Exactly. I mean, we've introduced a huge amount of uncertainty in the value chain in agriculture. And we've done that elsewhere in global value chains outside of agriculture. But if you look at the data, imports into China, about 33% were due to state-owned trading agencies. So the Chinese government has subsidized state-owned enterprises, like COFCO is a well-known example of a company that imports commodities. But that means about 2/3 of the trade in agricultural commodities was by private firms, right? And they're not necessarily going to be told by the Chinese government what to do because they're private profit-maximizing firms that will seek out the lowest price on the world market. So this relies on the Chinese government telling its own companies, you have to import more from the US. But what that ends up doing is that puts a barrier in the value chain between suppliers of soybeans, American farmers, and American trading companies like Cargill and others, and the end user in China. And I've heard, for example, the American Soybean Association, who spent a lot of time and effort building the fish farming industry in China, which uses soy protein to feed those fish. This now puts a barrier between, the supply side and the demand side, because it's all being driven by government mandate, a Chinese government mandate. And this, one of the reasons we went into a trade war with China was that we didn't like the fact that they were using state-owned enterprises and government subsidies, right? And now we're expecting them to use that system to import our commodities. It's just inconsistent as far as I can tell.
Yeah, I think, Professor Sheldon, probably ought to leave it there for today, but I do think this is so interesting. I hope we can come back and chat with you again. I don't know, maybe 6 months from now and evaluate 6 more months of data and see where we are and learn a little more about the sort of overall, the role of trade in our society and our economy is clearly important. So we appreciate you taking the time with us today.
You're welcome. Thanks for having me.